Today, we're diving into one of the biggest, most persistent puzzles in all of finance, momentum. It's this incredibly powerful force that honestly seems to defy everything we've been taught about how markets are supposed to work.
So let's just start with a question that kind of flips a core idea in finance on its head. We're always told that markets follow a random walk, right? That the past has absolutely no bearing on the future. But what if that's not the whole story? What if prices actually remember where they've been? Well, that's the core idea behind momentum. And it's shockingly simple. You buy what's going up and you sell what's going down. It's all based on this one observation that trends, once they get going, tend to keep going for a surprisingly long time. Winners just keep on winning and losers, well, they keep on losing. So, here's our game plan. First, we'll unpack why momentum is such a head-scratcher for traditional finance. Then we'll get into the big debate. Is it risk, or is it just us being human? After that, we'll see how it actually works in the real world, face its single biggest weakness, and finally, figure out where it fits in a modern portfolio. All right, let's get right into it. For decades, academics pretty much just waved this whole idea away. They thought it was a statistical fluke, just noise in the data. But then one groundbreaking study came along and completely turned that view on its head. Now, just think about that number for a second, 1% a month. It might not sound like a huge deal, but trust me, when you compound that over time, the returns are absolutely massive. This wasn't a fluke, this came from a serious, rigorous study, and it suddenly gave real legitimacy to an idea that most of the establishment had just ignored. And that's exactly why this was such a bombshell. You see, the efficient market hypothesis, the EMH, is like the bedrock of modern finance. It's the whole idea that all the known information is already baked into a stock's price, which makes the future totally unpredictable. But momentum was suggesting that maybe the past does hold a clue after all. So if we accept that momentum is a real thing, the next logical question is, why? Why does it work? And on this, the academic world basically split right down the middle into two camps. Is it a rational compensation for taking on more risk, or is it just a glitch in our all-too-human psychology? So on one side, you've got the rational view. This camp argues that, hey, these winning stocks are just fundamentally riskier, so of course they have higher returns. It's simply fair payment for taking on that extra danger. But on the other side, the behavioral camp says no way. This has nothing to do with risk and everything to do with how our brains are wired, our biases, our emotions, and our bad habit of following the herd. Okay, so how do we settle this? Well, we go back to the data. And the original study holds this fascinating clue. Take a look at that last row. Reversal after 12 months. This right here is the crucial piece of the puzzle. After about a year, the whole trend completely flips on its head. And this is a huge problem for the risk-based argument. I mean, think about it. If the winning stocks were just riskier, they should always earn higher returns to compensate for that risk. But they don't. The fact that they eventually crash and burn and even underperform the losers, well, that really suggests we're not looking at risk. We're looking at a temporary mispricing that eventually, painfully, corrects itself. The most convincing story from the behavioral side comes from a theory by Hong and Stein. It goes a little something like this. First, some news about a company comes out. The news watchers, these are your careful, fundamental investors, they slowly start to process it, and the price begins to drift up. Then, the momentum traders spot this little trend, they pile in, and their herd-like buying pushes the price way, way too high, creating a mini bubble. And then, eventually, reality kicks in, and the price corrects, leading to that big reversal we just saw. Okay, so we've got a pretty good theory about why momentum might exist. Now, let's get practical. How do you actually turn this academic concept into a real-world investment strategy? Turns out there are two main flavors. The classic academic approach is called cross-sectional. You take a whole universe of stocks, say the S&P 500, you rank them all from best to worst based on their performance, and then you buy the top chunk and short sell the bottom chunk. Simple. Time series, on the other hand, is different. It looks at each asset by itself. Is gold up over the past 12 months? Yes. Then you buy it. Is it down? Then you sell it. It's just a simple trend-following rule applied one asset at a time. Now, you can get even more advanced with something called residual momentum. See, the problem with basic momentum is that sometimes the stock is just going up because the whole market's on a tear, or because it's a small cap stock and all small caps are doing well. This method tries to strip all that noise out. It uses stats to remove those broad market effects, leaving behind only the momentum that is specific to that company. You get a much purer signal to trade on. So far, momentum sounds pretty great, right? But it has a dark side, a massive, terrifying Achilles heel. And that's what we have to talk about next, the momentum crash. The logic here is actually brutally simple. The whole strategy is designed to ride a wave, and that works fantastically until that wave suddenly and violently crashes. A momentum portfolio is always betting that the recent past will continue, so when the market bottoms out and then has a sharp V-shaped recovery, it gets completely annihilated. Just look at the market rebound in 2009. A momentum strategy would have been short selling the loser stocks, the ones that had been beaten down the most. But when the market turned on a dime, those were the exact stocks that shot up like a rocket, gaining 232%. Meanwhile, the winner stocks it owned only went up 32%. So you're shorting something that triples while owning something that barely budges. It's a recipe for absolute disaster. And there's the result, the brutal punchline, a 73% loss in just 3 months. It really shows you just how violent these crashes can be. They're rare, for sure, but they are a defining feature of the strategy, and anyone who uses it has to be ready for them. Okay, after seeing a number like that, you're probably wondering, why on earth would anyone touch this strategy? But it turns out momentum has a really crucial role to play, especially when you pair it with another, very different strategy. Meet momentum's perfect partner, value investing. They are polar opposites. They're like the yin and yang of investing. Value buys what's cheap and hated. It's a contrarian bet. Momentum buys what's expensive and loved. It follows the trend. And because of this, they tend to work at completely different times. When value is in the doghouse, momentum often shines, and when momentum crashes, value tends to do well. Put them together, and you get a much, much smoother ride. So let's tie this all together with 5 key pillars. First, it's most likely a behavioral thing, driven by how we react to news. Second, its biggest risk, the crash, is actually pretty predictable. It happens after market panics. Third, you can implement it in a couple of different ways. Fourth, it has amazing synergy with value investing. And finally, and this is a cool one, its high turnover can actually be good for taxes, since it generates short-term losses you can use to offset other gains. So, what are the big takeaways here? First, momentum is a real, powerful, and persistent force in the markets. Second, it's probably not about risk, it's about us, our behavioral biases. Third, it comes with this huge but manageable risk of sudden crashes. And finally, for most people, its greatest superpower is as a diversifier, especially when you pair it with a value strategy. And all of this leaves us with one last big question to think about. As long as markets are driven by human beings, with all our fear, our greed, our herd instincts, will trends like this always be a part of the game? Is momentum less of a flaw in the market and more of just a fundamental feature of who we are? Thanks for joining me on this explainer.